Welcome to a new video of Pendulo Force. We want to go back to basics and explain finance in a very easy way so anyone can understand. In our previous video, we talked about the financial structure of a restaurant, and today we're going to focus on the cost of goods. So let me start by sharing my screen. And so we said, let's have the example of a food stall, and we sell 1,000 burgers. And today we're going to focus on the cost of goods, and we are going to calculate the costing of a dish, and also the gross profit margin, or as it's mainly known, the GP. And we're also going to see how to do the costing of a full menu. The cost of goods and the menu engineering starts with the costings of all the dishes of our menu. We will see in another video how to do the costing with the full-on spreadsheet and real numbers, and what we include and what we don't. But for now, let's imagine that we only sell one product, and that's the burger, and that we have done the costing of the dish, and it's 3.60. The burger price is £12. We will also see how to price our menu in a future video. So the cost of our burger in percentage is 30%. And the GP would be 100% minus the 30% of the cost. So it will be 70%. You can find the formulas here just for you to see it maybe more clearly. So in our financial structure, if we only sell one product and that product has a food cost of 30%, our food cost for the whole menu is 30%. So now we are going to see what is the impact on that on our profits if something goes wrong with that cost of goods. So imagine that the cost of vegetables or the cost of the meat goes up, or maybe not by our suppliers. Maybe imagine that you're increasing your wastage and you are not realizing. And why it is important to track our cost to be able to understand our margins as well. So imagine that the costing increases for one of these reasons, and then the new costing is 420. So as you can see in the first one, our cost will be 30% and our margin will be 70%. So in terms of monetary figures, will be 840 will be our profit in the first case. And something goes wrong and then our costing increase to 420. And what that makes is our cost has increased to 35%. So in one burger, we will take only 7.80. So this is one burger, and we lose 5%, and that's in percentage. But let's see how much we really lose. If we sell 1,000 burgers a week, and then that means that we lose 60 pence per burger, we multiply by 1,000, and that would be £600 per week. But if we multiply by 52 burgers that we would sell in a year, that would be £31,200. That would be your profit, money you would have in your account at the end of the year if you have a good control of your cost of goods. And you could lose it. You could lose it if you don't. That's why having good control in place is very important, not only for your profits, but also for your cash flow. Now we're going to see how to control our cost of goods when we have a full menu restaurant. Okay, let's see how to do it. So the formula for the cost of goods will be initial stock plus purchases plus transfers you receive minus transfer you send out minus final stock. Transfers are things like staff cost, like a staff food. You will transfer that cost to HR, and you're able to deduct that as a cost in your P&L and therefore pay less corporation tax. Transfers could be transfers between different parts of your restaurant, like from the bar to the kitchen, or it could be from your restaurant. Maybe you have two restaurants, and it could be from restaurant 1 to restaurant 2. So you do transfers, so everybody has the cost that they really spend. Okay, so then the gross profit will be the sales minus the cost of goods, and the margin in percentage will be the sales minus the cost of goods divided by sales. Let's see this with numbers because I think it's much easier. One thing that is very important is that we have to make sure at all times that we are comparing purchases and stock within the same category. So if we're doing the cost of goods of the food and the cost of goods of the drinks, we separate them so we are not mixing, you know, meat with gin. And also, it's very important that we do it in a period of time. So if we're doing all this for 1 week or for 1 month, we don't take invoices from another month or transfers from another month. So let's see with figures, because I think it's much easier. So imagine you have an initial stock of 2,500, final stock of 2,300. Your purchases are 3,500. Your transfers to the bar, maybe imagine that you are part of the kitchen and you buy limes, and then they use those limes in the bar. So you transfer that cost to the bar. Transfers to staff, that usually is staff food. That is, for example, 100. So the total will be 3,350. And imagine that your sales are 13,400. We would have a cost of goods in percentage of 3,350 divided by 13,400 will be 0.25, so it's 25%. And then your gross profit will be 75%. So that it is for now. We're going to see it in the next video. We're going to see how to do this in a very practical way with an Excel spreadsheet and how you would do it on a daily basis in your restaurants with just a very simple spreadsheet. So thank you. If you have any questions, please send us an email to info@penduloforce.com. And if you want to see us in the next video and you don't want to miss any of our videos, please subscribe to our channel. And I hope to see you in the next one. Take care.